Good morning. It's Wednesday, the 31st of July, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai. The take: why we have to bring back friction in financial transactions. If I were to look back carefully on my online purchases, would I have bought everything that I have bought from Amazon, for example, if there was no Amazon, or for that matter, even online commerce? I pose this question to myself increasingly, and the answer usually is no. I would be buying much less if the ease of purchase and delivery was not there. But purchasing stuff online is not the same as using savings and borrowings to speculate in stock markets, which in turn is likely to blow up, as data is showing. Also, more likely that what I'm buying online is 80 to 90% aligned to what I would have bought offline in any case, at least in my case. I'm sure some such percentage applies to you too. Now, online trading was a step up compared to the old days when you had to call a broker physically and place orders to buy or sell a stock. Can you even imagine doing that today? Today, you could be anywhere in the world and trading via the same broker but on a smooth web interface or even an app on mobile. And that, in some ways, is the beginning of the problem. Also remember that your funds are linked to your bank accounts and you're empowered to take quick decisions and you know exactly what's going on. That's the good news, but then which leads to the bad news. Anyway, the next step, people take loans, which of course is the latest efficiency move thanks to lavishly funded fintech startups who have added their own discounts and incentives to attract business and find more customers and push up their value. And of course, all the time working with the same banking system at the back end. The result: millions of youngsters, or for that matter, even not youngsters, have taken small loans with a swipe on the smartphone, and many have used this to, among other things, speculate in the stock markets. More on speculation and derivatives later in the show. Now, this is where the problem is really developing. So the Reserve Bank of India on Monday has now acknowledged that emerging technology has led to proliferation of fraudulent apps and mis-selling. Of course, we are focused more on the second part. Fintech firms still face significant challenges in counterparty credit risk assessment despite significant footprint expansion, the Reserve Bank said in its report on currency and finance reported by the Economic Times yesterday. The Reserve Bank of India Governor Shaktikanta Das wrote in the foreword to the report that emerging technologies can introduce complex products and business models with risks that users may not fully understand, including the proliferation of fraudulent apps and mis-selling through dark patterns. Now, what are dark patterns? Well, dark patterns are those deceptive practices that are designed to mislead users to do something that they did not originally intend to do. For example, users could be compelled to perform unrelated actions or, in a way, tricked into making unintended purchases and creating a false sense of urgency, again to making quick purchases or maybe even taking a loan. So, by the way, India leads the world with a near 49% share in global real-time payments. So that also tells you how money is moving and how quick, though it may be in smaller amounts. On the other hand, India is one of the top recipients of fintech funding in recent years, with about $2.6 billion of flows in 2023. So all this fintech funding is creating smooth and slick apps which obviously accelerate the process of doing things which, in my mind, you should not be doing. The flow of funds into the fintech space is therefore something that one should watch carefully, perhaps much more than before. The Reserve Bank of India says, and I agree, that signaling risks also pertaining to big tech firms could quickly become too big to fail and dominate markets. It could become difficult for the regulator to assess risks because of their extensive group entities, interconnected activities, and transnational presence. This is, of course, I'm assuming, referring to organizations like Google. The Reserve Bank of India also says that the emergence of digital players with unreliable funding models accentuates vulnerability in the system and poses challenges to financial stability. It says that while the digital lending platforms and buy now, pay later services bolster consumer convenience, they also entail various costs, including exorbitant charges, coercive recovery practices, and hidden fees. In India, buy now, pay later constitutes about 3% of total e-commerce finance by value, but is expected to grow about 74% every year and is likely to become a roughly $56 billion market in just 2 years. And this model, by the way, also has a high dependence on late fees to ensure profitability, which could then become predatory for customers. So you have to, I guess, look at it differently then. What if all of this did not exist, that you could not get easy finance to buy things, and if you did not get easy finance, the prospect of you getting delayed on that finance or suffering and being unable to pay up in time is therefore not a situation that you might see. Anyway, the Reserve Bank also accepts that a digitalized financial sector can enhance credit assessment, reduce default rates, and broaden the access to finance. Incorporating alternative digital data such as cash flow, telecom, utility, and social media sources, and leveraging surrogate data allows creditors to comprehensively assess customers' ability and willingness to repay loans and enable real-time credit monitoring. So this is obviously all the good news that we've been hearing consistently for the last few years. But like I said, this is also a matter of nuances, and the good news is leading to more of bad news as we are seeing. So there are 2 or 3 kinds of problems. Most importantly, note that it has taken the Reserve Bank several years to take note of the problem of fintech-driven lending and in the manner that it has right now. Now, this does not mean that the Reserve Bank of India was sleeping all through, but rather the nature of the problem made worse by the speed at which it has escalated. Just yesterday, we spoke of how India has created a nation of young gamblers punting away at the stock market, often with borrowed funds. The positive of technology is that it allows rapid scale-up. The negative of technology is the same thing. Something can become very big very fast before you even know it, as it clearly has in the case, for example, of small loans. Now, regulators look at the top-level signals or symptoms, and it's quite likely that the balance sheet of the banks are safe, even if they are the ones who are actually behind all these fintechs who do all the accelerated, incentive-based lending for them. But the individual impact, both socially and economically, can be high, as we have repeatedly discussed on this show before. So we have to think of, even if you don't do anything right now, about increasing friction. For example, an OTP or a one-time password as a second layer of authentication increases friction while doing a transaction. And we've learned to live with it because we appreciate, at least in most cases, why it's being done. Of course, introducing more friction in loans or other buy now, pay later kind of schemes will involve other steps. I don't think that's difficult at all. It's only a matter of focusing on it. The larger challenge is, of course, behavior. You cannot sermonize to youngsters about how they should spend and where they should or should not borrow from. So forget public service campaigns. We have to think creatively, and I'm sure we can. It needs a combination of regulatory push, greater friction, and then, of course, the fear of what could happen if your loan goes bad, including the fact that the same technology will ensure you will not get loans easily again. And on to our top news of the day. The markets close at record highs but are still flat. Oil drops below $80 a barrel. The markets regulator lines up measures to curb derivatives trading. Betting on Trump becoming president, why you should buy gold then? A new con in Bitcoin. And finally, of all the projects being undertaken currently in generative AI, some 30% are bound to be dropped by next year.
This is the Core Report with Govindraj Ethiraj.
Markets and oil. The stock markets continue to rise, though very slowly for the third successive session, but still ending at new record closing highs. The movement overall is, of course, quite flat. The benchmarks, the BSE Sensex closed at 81,455, up about 100 points, and the Nifty 50 was up 21 points to 24,857. Amongst the broader indices, both the small cap and the mid caps did better. So the general view in the markets right now is that investors are continuing to book profits and somewhat steadily, which would in many ways suggest a fairly orderly market. So there are no specific triggers at this point, at least that I can see, that are evident, except the larger concerns on valuation, which of course is either a concern or not, depending on who you ask. Few institutional investors, particularly those who are bringing in funds, will acknowledge very high valuations because it's not in their interest to do so. Oil has dropped below $80. Oil prices have now fallen to the lowest in 7 weeks on doubts about the strength of global demand, while investors looked ahead to OPEC's meeting for guidance on supplies, according to Bloomberg. Global benchmark Brent crude is now hovering around $79 a barrel for the first time since early June. Bloomberg also reports that sentiment in the oil market has been subdued recently after China reported its weakest economic growth in 5 quarters earlier this month. And meanwhile, Russia's 4-week average crude exports have dropped to the lowest in 11 months, or late August as of last year. That decline, the fourth straight, says Bloomberg, likely stems from Russia's improving compliance with an OPEC plus output target, coupled with a recovery in domestic refining. Now, a recovery in domestic refining means more crude oil is being used and processed within Russia to produce maybe gasoline rather than being exported. SEBI on derivatives. India's market regulator, Securities and Exchange Board of India, on Tuesday has proposed a series of near-term measures to prevent speculative trading in index derivatives, including curbing multiple option contract expiries and increasing the size of options contracts, according to Reuters. India has flagged risks from speculative trading by so-called retail investors, says Reuters. So, the Securities and Exchange of India, this is all a proposal, by the way, has proposed to initially set a minimum value of about 15 to 20 lakh rupees for derivatives contracts, and after 6 months, it will raise the threshold to about 30 lakh rupees. Now, that means roughly between $18,000 to $24,000. The SEBI has also proposed weekly options contracts to be provided on a single benchmark index of an exchange and brokerages to collect option premiums on an upfront basis from their clients, and also an increase in margins on near-term expiry. Analysts told Reuters that the massive changes would bring down retail volumes on options, hit many high-frequency traders and people who use algorithms for trades as well as exchanges. And this, I would imagine, would be precisely the objective that the regulator has as it tries to cool down the markets as it must. Meanwhile, the activity in all the markets is, of course, good for the government's revenues. It apparently earned about 100,000 crores, 99,000 crores to be specific, from the long-term capital gains tax on listed equities in 22-23, that's last year, which in turn was a 15% growth over the previous year. This was told to Parliament on Tuesday. As taxes rise, as they have, and there is more activity, the government should earn more. My only hope is, of course, that it should all come back to us in some way, as it should. Gold, the hedge. Gold is the best portfolio hedge in the event Donald Trump comes back to the White House, according to the latest Bloomberg Markets Live Pulse survey. 60% of some 480 respondents told Bloomberg that they see the dollar ultimately weakening in the event a Republican candidate secures another presidential term. The interesting thing is the history of it. A Bloomberg gauge of the dollar says that it fell more than 10%, while the spot price of gold rallied over 50% during Trump's 4 years in office. Moreover, Trump's platform of tax cuts, tariffs, and weaker regulation are viewed as inflationary on Wall Street and could even force the Federal Reserve to raise interest rates again. Gold sits in a prime position to rally, an analyst at JP Morgan told Bloomberg. Also, if you were to look at bullion prices right now, they're being driven by geopolitical tensions, growing US deficit and Reserve Bank diversification, including India, which has been buying gold, and inflation hedging. So where does that leave us in India? Just getting used to lower gold prices thanks to lower customs duties. Well, that makes gold more attractive as an investor. The bizarre Bitcoin drama. I do not understand cryptocurrency, but I think I can smell a financial con being floated. An Indian cryptocurrency exchange said it would socialize the $230 million loss from a recent security breach among all its customers. Now, this move follows a hack into the exchange, which resulted in some half of its reserves apparently getting stolen. Now, this is the equivalent, if I can guess, of the Bombay Stock Exchange telling you that the money you paid while buying some shares on a particular day has been hacked into and gone. But then, the loss would be divided between all the buyers who paid into the stock exchange buying different stocks, though the hack may have specifically emptied out only some accounts. Now, this is my understanding. Actually, there is no clear or real equivalence between the Byzantine world of crypto and the real world of financial transactions, and which is why regulators world over, including, thankfully, in India, are wary of formalizing it. The Indian Express reports that socializing losses in what is a purely capitalistic venture has drawn the ire of crypto industry insiders who have questioned whether the strategy being explored by the firm in question, that's WazirX, has any legal backing and if it could pass regulatory scrutiny. The platform apparently faced a major security breach or hack earlier this month, which resulted in nearly half of its reserves getting stolen. Or so it claimed, I imagine. I reckon there is some way to check what these reserves were in the first place, but I'm not sure how that would work. Maybe there are people who are listening to this who can explain this better. Since then, either ways, the firm has halted deposits and withdrawals from its platform as it tries to come up with a workable solution to recoup some of its losses, which I'm frankly not able to understand how it could do that. The firm also called the breach a force majeure event beyond their control, which means that essentially it's put up its hands, and the government and the Reserve Bank, according to the Indian Express, are yet to publicly respond to the incident. The exchange said it was implementing a fair and transparent socialized loss strategy to distribute the impact across all users equitably and preserve the exchange's stability. And then it later added that it was only testing waters, possibly following the blowback. Now, there are some specifics to the mechanics of this, but that's not so relevant to our discussion. The larger problems are two. First, We are, as we've discussed repeatedly, in a highly speculative environment, which, even if all systems work fine, will detonate the savings of millions of young and perhaps old people too. We don't need to make the problem worse by allowing complex, opaque, and clearly non secure trading systems to exist, at least not without complete regulatory control and scrutiny. At this point of time, there is no such regulatory control on Bitcoin. Now, that itself should be a warning sign, though I'm sure it acts as the opposite, the attraction becoming more because of its opaqueness and the fact that the systems cannot be penetrated by regulators. I think all this was fine for a few years during COVID-19 when people enjoyed the mysteries that the internet and digital world offered. No longer. The platform has said it has filed an online police complaint on the National Cybercrime Reporting Portal and is processing a physical complaint. It's also reported the incident to the Financial Intelligence Unit, India, and the Computer Emergency Response Team, that's the CERT, which is part of the government. I'm equally and pretty sure very little will come out of this. Generative AI projects are dropping out. An interesting and new report by Gartner Research says that of all the projects being undertaken currently in generative AI or generative artificial intelligence, around 30% are bound to be dropped by the end of 2025, owing to issues such as poor data quality, inadequate risk controls, escalating costs, or unclear business value. A Gartner analyst says that after last year's hypes, executives are impatient to see returns on Gen AI investments, yet organizations are struggling to prove and realize value. As the scope of initiatives widens, the financial burden of developing and deploying Gen AI models is increasingly felt, according to that analyst reported by Business Standard. The report also said that a major challenge for organizations is to justify the substantial investment in GI for productivity enhancement, which can be difficult to directly translate into financial benefit. Moreover, the report said that despite many organizations leveraging Gen AI to transform their business models and create new opportunities, the deployment comes with significant costs ranging from $5 million to $20 million. I'm assuming some of that goes into the chips that NVIDIA makes, whose stock is now, of course, down more than 20% since its peak. Regardless of AI ambition, Gartner Research says that Gen AI requires a higher tolerance for indirect future financial investment criteria versus immediate return on investment. Now, we at the core report are increasingly focused on the role of generative AI, particularly from the enterprise side, and to understand how much of this investment is real and how much of this is likely to produce real benefits for organizations in the foreseeable future. We, of course, will also be talking to many people on this. For example, I spoke to technology columnist Siddharth Pai quite recently, and I posed to him the same question: how much of AI do we really need? And this is what he said.
I think the push from boards is large. I still advise largely friends more than anybody else, and just got back from a trip just late last night where the entire discussion at the board level was around what Nitin was talking about. And with tech-savvy people on the board, at least in my experience, I've seen there are specific use cases they talk about. For instance, they know that there are special areas in that particular company which have been areas of concern in the past, especially on the cost side or the efficiency side or the technology side. And they hit on those quite hard. The use cases for revenue building are still sort of up in the air. AI has always promised it. I mean, when I worked for the Carnegie Group in the US 30 some odd years ago, which was an offshoot of Carnegie Mellon University, the main problem we were trying to solve was that of upsell and cross-sell and so on and so forth by coming up with product recommendations. While AI used to try and solve that and is still trying to solve it, I don't quite see solid use cases around that just yet. Cost takeout use cases and the efficiency use cases are a lot more solid. So I agree with what Nitin said. I think at the CIO level and the CTO level, what they're getting, and the CEO level, to be honest, is the push that they're getting from their boards is be ahead of this technology, please, because it's a fundamental change in the way that we will be conducting business. Waves in the past was smaller, and you could afford to be a little late to the party. You could just have momentum take you forward. Like Accenture built up in India a little bit after, but they built up quickly. But not this one. You can't afford to be late to the party. So I think that's why boards are scrutinizing it as much as they are.
That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.